Right now, the market's a roller coaster. Inflation fears, geopolitical tensions, tech swings, volatility is through the roof. But what if I told you that this chaos is your golden opportunity? Instead of gambling on wild price moves, flip the script. Become the casino by selling covered calls and pocketing those inflated premiums. Stick around, I'll show you how this strategy wins over time, especially on high volatility stocks. And if you're tired of losing to the market, hit that like button and subscribe right now. So first off, the basics. A covered call is owning 100 shares of stock and selling a call option on those shares. The buyer pays you a premium up front, that's your instant income, and if the stock stays flat or drops a bit, you keep the premium and you keep your shares. If it rockets above your strike price, they'll probably call away your shares and you'll sell at that strike price you selected beforehand. But you get to keep the premium plus any gains on that strike. So why do this? With the VIX over 30 lately, implied volatility jacks up those premiums. You're getting paid more just for the market's fear. It's like renting out your stocks for extra cash while you just hold them long term. So here's the mindset shift. Option buyers are gamblers. They pay premiums hoping for a big payout if the stock moves their way. But sellers? Well, you're the casino. Casinos don't win every hand, but they win over time because the odds are in their favor. With covered calls, time decay works for you. Options lose value daily, so if nothing crazy happens, that premium is yours. Stats show that over 70% of options expire worthless, favoring sellers. In volatile markets, premiums are fatter, like charging extra for high-stakes tables. You're not predicting the market, you're profiting from uncertainty itself. Turn fear into your payday. So I wanted to go through my portfolio on some of the stocks I own and show you just how much you can make selling covered calls. So I use Option Strat to visualize how these strategies work in real time. So I own 20,000 shares of Snapchat. So if I type in 20,000, now I'm going to sell 200 calls. And I like to sell these calls at the money. So that means the stock's trading at $4.92. Well, I'm going to do the next highest strike, which is $5. And it's going to expire in 1 month. And I'll be able to collect 8% in just 1 month. Now that's as much as most investors hope to make in an entire year with the S&P 500. So that would result in a $7,500 profit if Snap ends up above $5. If it stays below, well, I'm still probably going to profit. Unless it tanks, which in that case, I just get a huge discount. I don't start losing money until after the stock has dropped more than 6%. So this is always safer than just holding the stock. If we look at another position of mine, 800 shares of Hood, let's see how much that would generate. Robinhood, so I'll type in 800 shares. We're also going to go a month out, April 10th, and sell it right at the money. So that would be $79. Need to update this to 8. All right, so this is 9.4%. Even more than Snapchat would pay right now. If we look at it on a dollar for dollar basis, that's almost $5,500. And just like before, if it stays flat or goes up a little bit, I'm going to profit a bunch. Even if it does go down, I have a 8% buffer built in. So it has to go down more than 8% before I start losing money. And at the end of the day, if it doesn't go up, I'm just going to continue to keep the premium and I keep the shares. So it's a win-win. Now let's look at Path. That is a position that I've started building over the past couple weeks, and they have earnings. So this might actually be even more. So yeah, April 10th, so 1 month out, we're going to do a $12 call. So I will sell my shares at $12 if it's above that a month from now. And I own 5,000 shares. So I can sell 50 calls. And let's look at the percentage first. That is a 15% gain. If the S&P did 15% in a year, guarantee you everyone would be happy. So why not do this and make 15% in a month? And that's if it just goes up 3%. Like, this is crazy. It's going to have to go down more than 10% before you start losing money. It's insane, and I love Path right now. I want to get as many shares as I can, as I think it's heavily undervalued and misunderstood by Wall Street. So if it goes above $12, well, I'll be happy with my almost $8,000 in profit. If it stays below 12, well, I get to keep the premium and I keep the shares. This strategy always creates a win-win. And it's how I've built my account to over 150,000 at just 23 years old. So there you have it. Turn volatility into your advantage with covered calls. Become the casino and collect those premiums and win long term. I'll see you in the next one.